Shares in Miton Group jumped more than 11% after it reported a 34% increase in adjusted profit before tax for 2018. Net inflows came in above £1 billion, up 106% year-on-year. Joining me now for an exclusive TV interview is David Barron, CEO at Miton Group. David, thanks so much for coming in. Congratulations on getting that £1 billion worth of net inflows. So you're a UK-based fund manager, mainly UK clients, a significant exposure to the UK. How are you managing to achieve these stellar net inflows when all there seems to be is this talk about political and economic uncertainty right here?
Well, yeah, so I think we had a strong year. 1 billion of net inflows put us amongst the top 10 of net retail sellers in the UK, a result we're very pleased with. And I think really what's underpinning that is the strong performance, but also differentiation of our funds. We set ourselves out to be genuinely active, and that means not only delivering good performance, but also good risk management and lower correlation. So I think we've seen inflows into our UK funds, and 50% of our assets, roughly, are invested in UK equities at a time when other groups, other areas have seen outflows. And that's really because we are doing something different, something that investors value. I would highlight one fund in that, the UK Multi-Cap Income, run by Gervais Williams and Martin Turner, one of the first funds we launched, which is really a template for what we do in the group. It invests to achieve good and growing income, but not just investing in the large dividend-paying stocks, but also AIM, mid-cap, small cap and other areas of the market, which gives, we think, greater resilience.
So you mentioned one of your funds there. I wanted to mention the Global Infrastructure Income Fund because that's been performing very, very well. Yeah. One of the funds that's been struggling a bit more has been in the multi-asset side. Yeah. Does that mean that the way forward is to be more focused?
So we think having the balance between single strategy, that's infrastructure, European opportunities, US, and multi-asset is a good one for the group. It enables us to address the UK market, our main market, as you mentioned, in two ways. So those funds, those buyers, investors who want to do their own asset allocation and pick funds, and those investors who want more of an outcome-based or solution, to use the jargon, and that's our multi-asset rate. I think, the end of last year, which was when a lot of the contribution to the weaker performance, softer performance came, was a really difficult time for many investors. And I think what we set out to do is be genuinely active, as I said. And what that does mean is there will be periods, sometimes extended periods, when our funds differ from the peers or the index. But I think the longer term numbers on the multi-asset range are good, and we think that's a great part of the market to be in. For savers and investors.
So looking to the future, where do you see the growth coming from? Is it organically, or would you look to perhaps doing some bolt-on acquisitions? And in terms of the funds, are you looking to open or close any new funds soon?
So we're not looking to close any funds, I can certainly say that. We've launched 3 new funds in the last 2 years. That's the US Smallers, the Balanced Fund in the multi-asset range, and the Infrastructure Fund. And those are all progressing well. As you mentioned, Infrastructure's got strong performance. US Smallers is up to 100 million AUM. So we will look carefully at launching new funds, both from the existing teams we have. Yes, bolt-ons is something we're interested in. I think where we can bring in good investment talent at all levels, we're certainly interested in that, and we've got an open door approach to that, where we can do that by buying a fund contract or some assets to enhance the development. We're certainly very open to that, and we've got the resource to do it.
So in terms of the Brexit uncertainty, how are you seeing that manifest itself through your business, and what's the appetite been like, particularly from the foreign market?
Yeah, I think that's an interesting one. So for the business, first of all, we're a very straightforward business. As you mentioned, we sell UK domiciled funds to UK investors. So that gives us simplicity, those kind of cross-border issues that many of our competitors are wrestling with, we don't have. I think what Brexit has done is changed the perception perceived risk, perhaps, of UK assets, particularly amongst foreign investors.
Unfairly, do you think?
Yes, I think it is potentially unfairly. I think UK has a real breadth of opportunity. We've got the most developed small cap market in the world. We've got a strong domestic, more mid-cap focused market, and many internationally exposed companies in the larger sector. So I think it is unfair, and I think, but that's the way markets are. There is clearly risk there and uncertainty. But we could see. I'm not going to call when it's going to clarify, but we could certainly see an opportunity when it does clarify.
So, given that your business in nature is quite a cyclical one, and it's more than 10 years on from the global financial crisis, what's kind of the rationale behind investing in your shares at this point in the cycle?
So the rationale for the shares is that I think we are, as I've said, a well-positioned business for the changes in both the savings and the investment market in the UK. We see there is this, shift between highly active funds like ours that can deliver a good outcome at an attractive cost, and very perhaps more passive, more benchmark aware, more factor aware funds that are perhaps lower cost, bigger volume, and both funds can complement each other. And I think we're at one end of that spectrum, and I think that's a very good positioning to be for the longer term. We've seen the profitability of the business grow. I think we're well positioned with our platform. We've seen a 40% plus increase in the dividend today as our profits has grown.
So the active share, is that a metric that you pay much attention to?
Yes, we think active share is important. We think it's important for clients. We think it's the kind of thing that regulators are increasingly looking at. So we do think if people, our clients, are paying an active fee, they want to see fund managers and teams taking a view, picking stocks and sectors on their merits, rather than necessarily constructing portfolios by reference to overs and underweights in our benchmark. So yes, we do think that's important, and it is something we look at. And broadly speaking, I think our funds, the active share, will be in the 80s, maybe in the 90s for many of those.
All right, now in terms of the assets under management, the equity funds were up 26% year on year. That was very strong. But investment trusts was one area of weakness, down 15%. Is that a concern for you?
No, it's not particularly a concern for us. There was one particular trust which has an annual redemption opportunity where shareholders can redeem their shares at net asset value. That keeps the discount in, it keeps it attractive for the long term. So some investors decided to redeem their shares last year. That accounted for most of the change. Investment trust is a smaller proportion of our business as the open-ended side has grown, but it's an attractive area. It's one we'd like to grow, but launching new trusts is always tricky.
And finally, I just want to get your outlook on the markets. How much more room do you think we have to run, particularly in US equities and European stocks as well?
So I think it's probably right to be a bit more cautious at the moment. It's very difficult to call the precise top in any markets, but by various measures you could see risk in the or valuations rather in the US being a bit elevated, the number of stocks that aren't are coming to IPO that aren't earning a profit. Things like that suggest that we may be at the higher end of valuations in the US. That said, in Europe, we're stock pickers. We don't particularly look to call the macro there. Likewise, in the US, we're stock pickers. But equally, yeah, there is definitely a case that valuations are elevated now.
So is that the biggest risk to your outlook, do you think?
So I think the outlook, I would differentiate between the shorter term outlook and the caution that there might be in markets, which I think is there, but it's harder to call on the precise timing, and the longer term strong positioning of our business, which I think is healthy with good funds, a good platform and effective distribution.
David, thank you so much for your time.
Thank you.
That was David Barron, CEO at Miton Group. I'm Victoria Scholar, and thank you for watching IGTV.